Hello, welcome to our channel of Tax Accountant. In this channel, we try to cover videos about small business owners, taxation, accounting theories, and things like that. Our aim is to provide you valuable guidance so that you can make informed decisions and understand the accounting and taxation concepts much better. So today I got this video here, a guide for small business owner explaining GST. So GST, what it is and things associated with GST, I'll try to cover one by one in a very simple form so that users like you can understand the GST. So I'm going to start with goods and service tax. So what is goods and service tax? Remember, the goods and service tax is a tax on consumption. I explain this simpler way. Let's say you go and buy fuel for your vehicle, right? Fuel. Now you pay $50 for the fuel. Now there is a GST component within that $50 because you have consumed it. So this is a GST is paid by your business on the consumption. Remember, GST is a tax on consumption, which is a goods and service tax. Whether it's a goods such as fuel is goods, or service, you go and see an accountant, it's a service, or you buy accounting software and using that software as a service, so that itself. So GST is a tax on consumption. Very simple, tax on consumption, right? So the second part we have, when do I have to register for GST? Now these are the questions in my last 20 years of working with small business owners. This is what I could see, that's what they need to answer. If you want answer me a specific question, you can ask me and then I can answer that for you as well. When do I have to register for GST? Okay, so registration of GST. The registration of GST will come in when you are actually doing a business, right? So there has to be a taxable activity. The GST Act 1985 that we know as of today has this word called taxable activity. Now this word is very important because all the court cases in the past have been around taxable activity. What is a taxable activity? The IRD can call you, this is a taxable activity, you must have registered for GST, why you have not registered? Or from the taxpayer point of view, you want to register for GST but you can't because there is no taxable activity. So the meaning of taxable activity is it has to be recurring in nature, so keep doing it on a regular basis. There has to be some sort of monetary value attached to the goods or services that you're doing, must be money or money's worth involved there. It has to be continuous basis. It can't be just do it today, not doing it tomorrow. So that sort of thing. So once these components are met, a regular, continuous monetary value, profit making or not profit making intention, but doing some activity, so that becomes a taxable activity. So once you're carrying a taxable activity, such as if you're driving an Uber, that's a taxable activity, a restaurant operation, building services is a taxable activity. One of the criteria as of today, this is the threshold of $60,000. So basically why we have this 60,000, it used to be $40,000 before, but it was changed to 60. There has been some conversation that they want this changed to $75,000. Could be next few years it might be changed to 75, but as of today $60,000. So what it is, what they're saying, the small, very small business owners who are just doing it on part-time basis can be outside of GST net. Remember, the GST Act is for the crown, for the government, it's not for you. It's mainly they want to benefit from it. It's the tax they want to collect off you, unless you're an exporter, which I will cover shortly, the export side. So registration will kick in when you're 60,000 and above. How to register? Very simple. Go on IRD website, myird.gov.nz. Go on the website and register yourself. This is how simple it is. Just fill a few forms, you can register yourself. If you need any technical advice, you can talk to tax professionals, they'll advise you. Now when you go to the registration page, they'll ask you a few questions. Or do you want payment basis or do you want invoice basis? So this is the thing can kick in, payment basis versus invoice basis. I explain you what is payment basis and invoice basis is. So basically the payment basis is when I pay you, then I claim GST, and when my customer pay me, I'll pay GST. For example, I raised an invoice to a customer. So this is my customer. I raised an invoice $1,000 plus GST. So GST on $1,000 will be $150 because 15% is GST. So 1150 is my invoice. Now I have raised this invoice today, 16th January. This invoice is raised today. Now, I'm just hypothetical situation. This is 2 monthly GST, and the GST period is 1st December 24 to 31st Jan 25. Right? This is the GST period. Now the date 16th January is between these two dates, as you can see. Now if it's invoice basis, whether the customer has paid me or not, that doesn't really matter. If the customer pay me before 31st Jan, well good, but they don't pay me before 31st Jan, I still have to pay $150 GST to IRD. Now this is invoice basis. If it's payment basis, I'm saying, oh, this is the GST period, but hey, remember this customer has not paid me GST. I'm not paying you. Sorry, Commissioner, I'm not paying you the GST. They can say that. So they can only do it if they are payment basis. They can't do it if they are invoice basis. So that's the core difference between invoice basis and payments basis. Likewise, if it's a supplier bill, I have not paid that bill. If I have not paid that bill, then I can't claim the GST back either. Okay, it's the same theory. Whatever is on invoice, it's also on to payments part as well. Now you must be thinking, oh, it's a pretty cool feature. Why not everyone to use it? There's a catch. It's only available for small businesses. The large businesses cannot get that as an option. Top of my head, I think 2 million, that's the catch here. Below that, you can, after that you can't. Okay. Okay, it's very important I cover New Zealand GST versus other parts of the world as well. Now this is just out of the understanding the GST part as well. What is New Zealand GST? Let's look at versus Australia. I'm not Australian tax consultant, but understand a little bit Australian GST as well. So remember one thing, New Zealand GST is 15%, Australian is 10%. Now New Zealand GST is very unique in the world, very unique. We have very little exemptions in our GST. Pretty much everything attract GST except few larger items such as rent, residential rent only, not commercial. So residential rent, no GST. Loans, mortgage loans, car loans, all sorts of loans, basically financial things, finance, no GST. So these are the two large components which is no GST. There are a few exceptions here and there, minor things, but remember that on top of that, these are the two main buckets. everything else has GST. There is no healthy food exemptions, nothing like that. Australia do have healthy food exemptions. So, but there have been many court cases. I know a good friend of mine. She's a investigators in Adelaide, and they were saying how ATO comes into numerous problems in terms of understanding once you put chocolate on top of apple, is this healthy food or this is not healthy food? So they have many court cases, and New Zealand do not have any. So this is the most simplest form of GST, but again, it's not good enough for the customers. They end up paying GST on everything, right? But from the administration point of view, from the commissioner point of view, it's easy for them to administer because they can say simply, hey, GST apply on pretty much everything. Now, other parts, Singapore, I think it's 5%. Raro, Tonga, I just did the tax advisory today. They also have 15% actually. Yeah. This is just for a glance of it so you understand. Some parts of the world call it VAT too. They call it VAT, they call it value added tax VAT, which is GST, goods and service tax on consumption. It's the same thing. Now we have another thing, GST calculator. Now it's a simple thing, but just for you to understand how GST calculator works is if you have a product of $500, this is the $500 product, and GST is 15%. Simply 500, put into calculator, 500 times 15%, which is 575. So 75 is a GST. So GST inclusive value will be 575 and $75 is the GST. Now again, someone has given you, hey, this is $575. Now what would be the value of that exclusive GST? So 575, simply divide by 115 times by 100. As simple as that. You get $500. So divide by 115 times by 100. Right? Very simple. Very quickly, GST to customers and GST bill to supplier. So how does that work? Right? So when you're invoicing to your customer, so and when what you're looking at, so when you're invoicing to your customer, this is the tax invoice. Now tax invoice will have a name of the person that you are sending invoice to, their address, right? So they will have that name, address, and the amount what you're charging. Let's say you're charging $1,000, and the GST component, which is 15%. This will be the invoice to a customer, and customer will pay you. At the same time, when someone's sending you an invoice, very much same component will be on that invoice, and then you will get it. Recently, the law has been changed from e-invoicing, so a lot of the information could be part of your accounting software. No physical copies of these invoices, no physical records of these invoices are required. It could be part of just e-invoicing. And also, law was changed to ensure that we, as small business owners, not burdened by compliance on the small invoices. Like when you go and buy something and they don't give you the invoice, you don't have to worry about it if it's less than $200. So what IID is saying is a small bill, $200, don't worry about the invoice. But at the same time, record keeping is required. Make sure it's paid by your bank accounts, not cash. Also, there is no tax avoidance happening. Has to be legitimate business expense, right? So those things must be there. Now again, just the last part. GST, look at the big umbrella, right? This is the GST, for you to understand. Now GST has three components to it. One is standard. So when you're looking at your GST, like as a return. When you see the GST return, you see the return, you will see the three parts include. One is standard. Standard means 15%. So your invoices and your payments got 15% GST in that. One is exempt. So exempt means no GST apply on these things. Already mentioned all the finance things like loans, mortgage, bank fees, cash withdrawals, drawings, whatever, those things will go into exempt. And there is export. So export being goods are not being consumed locally in New Zealand. These goods or services are being exported overseas. So the consumption is happening outside of New Zealand. If it's outside of New Zealand, then GST will apply at a 0%. There is one more portion to it. Some of you might import stuff from overseas. So if you import goods in New Zealand, then there will be an import portion to the GST which will be paid through New Zealand Custom, and New Zealand Custom will more likely charge you whatever the value of the goods are. If the value of the goods are $1,000, they'll charge you 15% GST. So $150, they'll charge you New Zealand Custom along with custom clearance fees and their commission and admin fee and things like that. So that could be charged by them, but all the GST can be put into GST return and you can claim it back from them. That's about the GST. If you have any questions, please contact us. If you like this video, subscribe to our channel and help us grow further. Thank you.